Liquidity risk in financial institutions. Liquidity is one of the most critical aspects of financial institution analysis because banks and insurers must continuously meet obligations to depositors, policyholders, creditors, and counterparties. Unlike many industrial companies, financial institutions rely heavily on short-term funding while holding longer-term assets. This maturity transformation creates liquidity risk, particularly during periods of financial stress. Analysts assess liquidity by evaluating funding sources, asset liquidity, deposit stability, and access to capital markets. Strong liquidity management allows institutions to withstand unexpected withdrawals and market disruptions. Weak liquidity positions can quickly escalate into solvency concerns, making liquidity analysis a key component of overall financial institution assessment. Liquidity metrics and Basel III requirements. The Basel III framework introduced important liquidity standards designed to strengthen banking system resilience. Two major measures are the Liquidity Coverage Ratio, LCR, and the Net Stable Funding Ratio, NSFR. The LCR evaluates whether a bank holds sufficient high-quality liquid assets to survive a short-term stress scenario, while the NSFR measures the adequacy of stable funding relative to the liquidity requirements of assets. Analysts also examine maturity mismatches between assets and liabilities because significant mismatches may expose institutions to refinancing risk. Effective liquidity management reduces vulnerability to funding disruptions and improves a bank's ability to maintain operations during adverse market conditions. Sensitivity to market risk. Sensitivity to market risk measures the extent to which a financial institution's earnings and capital may be affected by changes in market variables. Important sources of market risk include interest rate movements, foreign exchange fluctuations, equity market changes, and credit spread volatility. Interest rate risk is particularly significant for banks because assets and liabilities often differ in maturity and repricing characteristics. A rise in interest rates may affect loan values, deposit costs, and net interest margins. Analysts evaluate sensitivity using duration analysis, gap analysis, stress testing, and scenario analysis. Understanding market risk exposure helps determine an institution's vulnerability to unfavorable economic and financial conditions. Additional factors beyond CAMEL's analysis. While the CAMEL's framework provides a structured approach for evaluating financial institutions, analysts should also consider broader qualitative and environmental factors. Government support, ownership structure, competitive positioning, business strategy, and corporate culture can materially influence risk and performance. Institutions with explicit or implicit government backing may benefit from enhanced market confidence and lower funding costs. Competitive dynamics affect profitability and growth opportunities, while corporate culture influences risk-taking behavior and governance quality. Off-balance sheet exposures and business segment diversification also deserve attention because they may create risks or opportunities not fully reflected in traditional financial statements. Currency exposure and off-balance sheet risks. Financial institutions often maintain substantial international operations, creating exposure to foreign exchange risk. Currency fluctuations can affect earnings, asset values, capital ratios, and cash flows. In addition, many institutions engage in derivative transactions, guarantees, securitizations, and other off-balance sheet activities that may generate significant contingent liabilities. Analysts must carefully review disclosures to identify risks that are not immediately apparent from the balance sheet. Understanding these exposures is essential because market disruptions can quickly transform contingent obligations into realized losses. Comprehensive analysis therefore extends beyond reported financial statements to include supplementary disclosures and risk management practices. Characteristics of insurance companies. Insurance companies differ from banks because their primary business involves underwriting risk rather than transforming deposits into loans. Insurance firms collect premiums in advance and invest those funds until claims must be paid. This accumulated pool of investable funds is known as float. Insurance operations are generally divided into property and casualty, P&C, insurers, and life and health, L&H, insurers. P&C insurers typically write shorter duration policies and face claim volatility from catastrophic events, while L&H insurers manage longer-term obligations related to mortality, longevity, and investment performance. These structural differences require specialized analytical techniques and performance measures. Analysis of property and casualty insurers. Property and casualty insurers are often evaluated using underwriting performance metrics. One of the most important measures is the combined ratio, calculated as total insurance expenses divided by net premiums earned. A combined ratio below 100% indicates underwriting profitability, while a ratio above 100% signals underwriting losses. The insurance market experiences cycles known as hard and soft markets. Hard markets are characterized by rising premiums and stricter underwriting standards, whereas soft markets feature increased competition and lower premiums. Analysts assess underwriting discipline, reserve adequacy, catastrophe exposure, and investment portfolio quality to determine the financial strength and sustainability of P&C insurers. Analysis of life and health insurers. Life and health insurers typically maintain longer duration contracts than property and casualty insurers, resulting in larger investment portfolios and greater exposure to interest rate risk. Because benefit payments may occur many years in the future, profitability depends heavily on investment returns, actuarial assumptions, and liability management. Analysts focus on reserve adequacy, asset liability matching, capital strength, and earning stability when evaluating these companies. Interest rate movements can significantly affect both investment income and the present value of future obligations. Consequently, understanding the interaction between underwriting performance, investment management, and risk exposure is essential for assessing the long-term financial health and valuation of life and health insurance companies.